We're in Chicago, just north of Chicago, Northfield, Illinois.
There you have it.
Welcome.
So kind of all across the board today. Any relation to Brandon Zemp? There's got to be. There's only a few of us. All I'd say is I'm probably better looking. So I don't know. I don't know what that means. Poor Brandon, I guess. So let's get this the presentation up and going. So Spring, if you can enable the sharing there, I'll start the slides. It's like the question and answer panel is going great, and Spring will be monitoring the question and answer panel. So feel free to ask any questions there, and any of the longer questions, Spring will actually put into a separate document, and we'll try to work in. We're also going to reserve a little time at the end for some Q&A. Perfect. Let's see. So I think just to kind of make sure that everybody's on the same page, this is actually part 2 in a 3-part series. Our previous webinar was more crypto basics, more the technology side and less of the tax side. Today we're going to dig into the tax side of things, and kind of we will talk about the technology as it relates specifically to taxes. But I think I'd like to start by asking a few questions to kind of gauge what the understanding of the audience is already. I think some of you participated in the first part. Some of you deliberately waited for the second part because you felt like you already knew what was going on. Some of you are surprised to find out that there was a previous part. So let's ask a few questions, and I'll get the slides up here while everyone's answering. But let's first things first. These are just going to be yes or no questions. Do you feel like you have a basic understanding of blockchain? So just hop in the chat, yes or no, and that'll help us kind of gauge how deep to get in on the technological side. I'm seeing a few no's, mostly yeses. Okay. Okay. Excellent. Lots of yeses. I don't have any clients, but a few introductory webinars by our CPA Academy. You might have actually seen me on CPA Academy. I think I've done about, a couple dozen trainings over there too. Excellent. Okay, let's ask the next question here. Do you feel like you understand the difference between cryptocurrency and blockchain? So just quick yes, no. Maybe. That's a good one. Awesome. Okay. So it looks like about 70% yes. Okay. Let's go next question. Can you name, okay, this is like Price is Right stuff, right? Can you name 5 coins, or maybe even 2 coins besides Bitcoin and Ethereum and Dogecoin? Because those are the 3 that are always in the headlines. Would you feel comfortable? Excellent. Okay. A lot more no's on this one. Honestly, I might be a little hard pressed if I was put on the spot like this. Holy cow. Comp, Uni, Link, ADA, SNX, Aave. We're good. Although half of these I'm sure I'm mispronouncing, right? These aren't even real words. Dodge Caravan. No, that's not a coin. that's a minivan, actually. All right. Do you understand the difference between fiat and crypto? Yes or no? Fiat and crypto. Maybe I should just ask, do you know what the word fiat means? Yes, fiat is fake. Thanks, Neil. That's awesome. Great. Okay. All right. I think this really helps. Max, are you able to see these responses as well? Awesome. Okay.
Yep.
Yeah. So this really helps. A couple more. These are kind of the deeper stuff. Are you familiar with DeFi? We actually are. One of our programmers likes to call it DeFi, and I want to punch him every time he says it. Again, it's another one of these made up words, right? But it's actually short for decentralized finance. So I always say DeFi. But okay, so kind of in the middle there. Okay, how about fork? If I say the word fork, can you give me a definition other than something you eat with? Means nothing to me. All right, thanks, David. That's funny. All right, good answer, Dylan. All right, for those of you who said yes, do you understand the difference between a soft fork and a hard fork? Okay. All right. Okay. Enough quizzing. So that gives me a pretty good idea of where we're at and how to relate better with the audience here today. If you feel like this is going over your head already, I'm going to post a link here for everybody. And this is our last webinar. It's on our YouTube channel. And if you feel like this is going over your head, then feel free to go to that link and you can watch that webinar. And that'll kind of help with the technological side. That doesn't mean that you should necessarily jump off of this webinar. We're going to talk more about tax stuff in this webinar. But if you feel like you're having trouble with the technological aspect, then that's a link to our webinar that's specific to the tech aspect. So let's, without further ado, let's hop in here and get going on the presentation. Here we go. So just what we talked about, part one is the tech side, part two is the tax side, and part three is meant to be more interactive with the audience, where you can bring us specific questions and we can talk to you about your particular situation on really kind of advanced scenarios. So we've just completed your temperature check. Hopefully, I think that's probably as informative as it was for you, as it was for me. But why now? Why are we doing this now? Why is this germane? The 1040 tax form this year, so for the 2020 filing year, you'll notice right down in the middle on page 1 of the 1040, it says, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? And that is a weighted question, and there's a lot of ways to interpret that. And in fact, a lot of the items in the list may not even be taxable. So some people have called this a perjury trap. Others have just said, oh, no, it's just a simple polling question to see, whether this is something that the IRS needs to pay attention to. I think you do well to treat it as both. Yeah, I think honestly, I've sat down in closed door meetings with the IRS as they've formed some of their regulatory releases, and the long and the short of it is that the sense that I've got has been that it's still a minor piece of the economy, but it's certainly one they're paying close attention to, and they don't expect it to be going away anytime soon. So they're setting it up now for success in the future. They've also said that a few large cases like John McAfee, if they can nail a few Bitcoin billionaires, the big whales, that they feel like that'll kind of tip the scale and improve compliance. The biggest issue that tax professionals are facing right now is a lot of them will tell me, oh, I've only got 1 or 2 clients that have crypto. And the fact of the matter is, statistically speaking, 1 in 10 of your clients has crypto. Now, only about 1 in 100 are actually filing on it, even less. So we're finding a lot of tax professionals will do about 150 filings, 200 filings. On 200 filings, you should expect to see about 20 of them with crypto on their tax return. But right now it's only about 2. So 2 out of 200. So just to kind of give you an idea, compliance is the big issue right now. And why is that important for you? It presents some really interesting opportunities as you go back to your clients and say, hey, you need to be amending past returns. It's also important for you to know your liability in this whole situation, as well as being able to explain the liability to your clients. Crypto also presents some really interesting advisory opportunities where you can come in and say, hey, look, it's time to start treating this a little bit differently, or these are some tax write-offs that you might have where you're mining crypto, where most people don't have that sort of thing. So advisory opportunities as well. So without further ado, I'll turn the time over to Max to actually get into the real meat and potatoes here of the tax side of things. So Max, tell me, is cryptocurrency really a currency? Because that's kind of one of maybe the biggest misnomer in the entire industry. Is cryptocurrency really a currency?
It's a good question. And you're right, it is a misnomer. It's generally no. The IRS has in 2014 came out and said, we're not treating this like currency, we're treating it like property. And I guess to make that even clearer, one of your questions when you're sort of doing your little temperature check, coming in to see what everyone, where everyone was, one of the questions you asked is, what is fiat, or do you know what fiat is? Fiat is government issued currency. Cryptocurrency is not government issued currency. So I think that's kind of just like an easy way to think about it. And for those of you in the chat that didn't know what it meant, that's what fiat is. Fiat is currency. Cryptocurrency is thought of as just like property. It's more akin to stocks. And a lot of what we're going to talk about today, as far as tax reporting, is going to be analogizing it to stocks, because there are just many similarities there, Jared.
Thank you. Yeah, I think that's pretty interesting. And one of the ways it was explained to me, especially as it relates to tokens versus coins, is the crypto is often actually more like a Tupperware container, and the way it's taxed is often based on what's inside. If the token represents a piece of art, like an NFT, then it would be taxed a little differently than if the token represents, say, a piece of real estate. But I think by and large, if we're talking about coins, then it really is a lot more. It's property and a lot more like stocks. Do I understand that correctly?
Yeah, I think if I'm understanding you correctly, generally, yeah. Whether or not it's a token or a coin, I would say, I don't know, 99% of the time, it's likely going to be treated almost like a stock as far as tax reporting. NFTs can be a little different because that gets sort of into the taxation of collectibles, things like that. But by and large, I would say the vast majority of the time, it will be treated more or less the same.
Yeah, no, that makes good sense. So perhaps the largest difference then, when you're talking about taxing property as opposed to taxing currency, is capital gains. So take it away. Let's address that for a minute.
Right. So the two big buckets as far as taxation of crypto are capital gains and income. And so first here, we're talking about capital gains. Capital gains get triggered or are incurred when you have the sale of a capital asset. You have sales of property. And that's what we just said cryptocurrency is. And so what exactly does that mean? What is your obligation? We as taxpayers have a duty to report every single disposition of crypto, every trade of crypto, every sale of crypto. If you acquired it and then you disposed of it, traded it, sold it, you have a duty to report that. So that includes selling crypto for money, which a lot of us hope to do and become rich and retire. But people also use crypto to buy things. If you use crypto to buy something, in the eyes of the IRS, it is treated exactly the same as if you sold it for US dollars or if you sold it for fiat, treated the exact same way. Sorry,
Max, that is kind of a scary proposition. I mean, we talk about people who way back in the early days of Bitcoin, when it was only worth a few bucks, they bought pizza with Bitcoin, and that's kind of the most famous example. And then they say, oh no, well, geez, if I would have just held on to it, I mean, that's the most expensive pizza ever, right? But it sounds like what you're saying is that even nowadays, if I were to use my Bitcoin to buy pizza, that's suddenly a taxable event. Is that true?
100%. So kind of like we were saying before, if you sell it for USD, if you use it to buy something like a pizza, or if you use it to trade one crypto for another, that is also taxable. It is treated as if you sold it. And the crypto to crypto one is the one that really trips people up, because they say, well, guess what? This would be, I think, people in the chat are accountants. This is probably something you would hear often from a client. All I did was buy. I never sold. I never sold, nothing. But then the first question I would ask them was, did you take one crypto to buy another one? Did you buy Bitcoin and then use that Bitcoin to buy something else? That would be one of the first questions I would ask them. Because if the answer to that question is yes, then you have reportable events and potential tax liability. Every time you trade one crypto for another, use it to buy a pizza, use it to tip Jared for his wonderful presentation, or use it to sell it for USD, you have to report a few things. One is you have to report the proceeds from the sale. And what does that mean? It's what is the fair market value of what you disposed of at the time of the disposition, at the time of the sale, at the time you bought the pizza. What is the fair market value at the time? The second thing you need, and that's the proceeds, that's a gross number. That's always going to be a positive number. Then the second thing you would need is the cost basis. The cost basis is simply what you acquired that crypto for. That's also always going to be a positive number, but it may be higher or lower than the first number, which was the proceeds from the sale. Depending on which way you end up, gives us our third number, which is whether or not you have a gain or a loss. And so for every single crypto to crypto trade, every single disposition of your crypto throughout the year, you report those, you calculate a gain or a loss. At the end of the year, you tabulate whether or not you had a net gain or a net loss. And the other thing that's important to remember here too is what is your holding period in each of those assets, because the holding period dictates whether or not you have long-term capital gains or short-term capital gains. Basic difference here, short-term, if you held it under a year, or for a year or less, it's taxed at your ordinary income tax rate. You're in whatever tax bracket you're in, that's the tax rate. If you hold it for longer than a year, you get the benefit there. You get a lower tax rate. Now, the tax rate is often beneficial in informing your decisions, but it's not necessarily dispositive, because it could depend on what the market's doing. Maybe the market temporarily went really high and maybe that's the best time to sell. So, I mean, tax planning is one thing, but it's definitely not, financial advice.
Right.
I guess important thing there. But tax
so, Max,
considerations
it sounds like if I'm doing a crypto to crypto transaction, for instance, I'm buying Ethereum and I'm selling Bitcoin. So there's no US dollars involved.
Correct.
Then how do I establish my cost basis and how do I establish my gross proceeds? Because there isn't any US dollar amount involved there. How would you go about that?
The short answer there is fair market value, but let's walk through an example and put some numbers on it instead of being as abstract. So you buy one Bitcoin. I don't know what the price of Bitcoin is right now. Let's say it's $30,000.
33,000. Yeah.
33,000. You buy one Bitcoin for $33,000. So right here, you buy it for 33,000. You buy it using US dollars. So question number one is this a taxable or reportable event? The answer is no. And this is actually goes This is actually a really important point, and we talked about it in our first webinar, and we talked about it a few slides ago. On the 1040, where you had the, the did you buy, sell, send, receive, this one.
Yeah.
This seems like an extremely broad question. This question seems to ask, if you breathed on crypto in any way, check yes or no. And we think the answer would be yes. But not that long ago, the IRS updated their FAQs on crypto and virtual currency. And they actually said, if you just purchased it with USD, then you actually don't have to check yes to this question. And we alluded to that in our last time. And it is counterintuitive, because it just seems like if you possess any crypto, the answer to this question should be yes, but there is a limited time. So that's our step one. I took Bitcoin's 33,000. Jared said I took $33,000 because apparently I have $33,000. I bought one whole Bitcoin. Not taxable. Don't have to check yes on this. We're good. Nothing.
Okay.
But then now let's say months go by and the market is much higher now. The market's recovered. Bitcoin's back up to $60,000. So now it's $27,000 more than you bought it. The fair market value of one Bitcoin is now $60,000. You have an unrealized gain of $27,000. And to use your example, you say, I want to take my Bitcoin and buy Ethereum. The moment you do that, it is this, even though there was no US dollars involved, this is months later, the market has appreciated, you'll incur a $27,000 gain on your Bitcoin. And secondly, what will be the cost basis in the Ethereum you bought? Well, if you took that whole Bitcoin and traded it, you didn't just buy one Ethereum, you bought several Ethereum, dozens, 100, however much Ethereum is worth at the time. And that is your cost basis in the Ethereum. So now you traded the Bitcoin, you have a gain of 27,000, and your holding period in the Ethereum starts the day that you traded the Bitcoin for it, and your cost basis is the fair market value for which you bought it.
And fair market value can be kind of a greased pig, I think, because Bitcoin trades at a bit of a different price depending on the exchange, and especially depending on the country. We'll see actually sometimes some vast differences in the value of Bitcoin, say in Venezuela or Argentina versus in the United States. And so I think that one of the things that ZenLedger steps in and does really well is establish a spot price for Bitcoin at that particular moment when you did the crypto to crypto trade. And so I think that's where having good software on the back end makes a pretty large difference, so that you don't have to go out as a tax advisor and say, hey, now I've got to evaluate the value of Bitcoin across, the market. How do I establish that fair market value? Am I on point there, Max?
Yeah, I think you're on point there. I probably wouldn't really overthink that one. Typically cost base, it's cost basis, fair market value. It's what you acquired it for. Sure, there's arbitrage between markets, but in general, I would probably trust the software that you're using to aggregate the correct spot price at the time.
Awesome. How are fees calculated? I mean, when we're talking about the biggest difference between Bitcoin and Ethereum, a lot of times Ethereum has a much higher transaction cost than Bitcoin does. And so how do fees come into play here on your capital gains and your cost basis?
What I believe ZenLedger does, and what I believe a lot of tax softwares do, is it factors the fees into the basis. So let's stay consistent with our example. We bought one Bitcoin for 33,000, but there were some fees involved. I mean, those fees are probably going to be in USD at the time. So I believe the fees would just get added to the cost basis. And likewise, when you sell, I think softwares typically subtract them from the proceeds of the sale. So it's not as if the fees are part of the gain. That's how I think most softwares are treating it. And I think that's the general position.
Yeah, I think that's correct. Tell me more about this Form 8949. We've talked about capital gains. How do I actually file it? What sort of paperwork is involved here?
Sure. So we said at the beginning, every time you sell for USD or fiat, every time you buy pizza, every time you trade crypto to crypto, you have something to report. You have a trade. Every time one of those happens, it gets its own line on this form right here that Jared has on the screen, Form 8949. Form 8949 is where you just list out every reportable crypto event, where you have the date acquired, the proceeds, the cost basis, and the gain or loss. So some people might have one of those. Some people might have 100,000 of those because they're so actively trading crypto to crypto. They might be doing what you were doing, Jared. They might be trying to realize gains from the arbitrage between markets. There could be any number of ways that would trigger a reportable event. Nonetheless, all of those reportable events go on Form 8949. We said earlier too that at the end of reporting all of those trades, the software will tabulate whether or not you have a net gain or a loss on the year. The single line item of whether or not you have a net gain or a loss goes on Schedule D of your 1040. 1040 obviously is just the tax form that we all file every year. Schedule D is where you would report the overall net gain or loss of your sales. And Form 8949 is where you list out every single one. You need all of them.
So, I mean, I can imagine, like you're saying, some of these, we seem to have clients at ZenLedger, we seem to have clients kind of in three buckets. We've got the people who just kind of dabbled in it, you know, and they might have anywhere from 2 to 20 transactions. And then you got your average people that are sitting in about the 200 transaction range to the 2000 transaction range. And then you've got your high frequency day traders that are sometimes, you know, north of 80,000 transactions at a time. I think for that first category, you know, dabbled in it, 20 transactions, that's feasible to do by hand. But at the point where you're now having to manually enter, you know, 200 or 2,000 or 80,000 plus transactions on this 8949, I'd imagine it gets pretty onerous for tax professionals. Hey, Mark asked a good question. He says, let's talk a little bit about mining, and let's talk a little bit about crypto as income. Sure. And incidentally, that happens to go along really well with our slides. So, Max, how is income treated?
So income is treated so the first bucket of what we talked about was capital gains. That's when you buy something and then sell it. Income happens when someone, for example, pays you for something. You perform a service and you get paid in crypto. I almost don't want to overcomplicate the concept of income, because income is income. You know, you go to your job, you make how much you make, and you get your W-2. People sometimes might transact in crypto. You might get paid in crypto. And so this would really just factor into your, I guess, the tax rate for this is just whatever your income tax bracket is. Now, how do you calculate how much income you have in US dollars? Because tax returns are always reported in US dollars. You're not going to see, you know, I got paid 1 Bitcoin on my tax return. You're going so the question is, or how do we do it? The answer is fair market value. If you got paid 1 Bitcoin, 1, lucky guy, 2, you would just say, oh, I got paid on July 15th at 2:32 p.m. What's the fair market value of 1 Bitcoin at the time? That's the USD value that you have. That's your income. And the same is true if you get paid. And there are other things that we see on the slide that constitute income. Airdrops and forks, we talked about those earlier. An airdrop is almost exactly what it sounds like. It's when really a crypto kind of just shows up in your wallet because someone is decided they were going to distribute a bunch of the coins. Those are income. Some people don't like that because, you know, you weren't really asking for it. It just kind of showed up in your wallet. They're often not worth that much. So, I mean, I wouldn't really fret about it. I mean, usually it's not that much. A fork, on the other hand, we kind of talked about this in webinar 1, but essentially that's when you have a protocol and that sort of, it quite literally fork in the road. One keeps going this way, the other goes a different direction, and a new coin is minted. What's your income there? Whatever the fair market value is at the time that you got it. In our other webinar, we also talked about proof of stake, and we compared that to mining. not going to go through again sort of what is mining and what is proof of stake. But as far as their taxation, there's actually an important distinction here. Proof of stake we talked about was when you essentially hold your crypto in a particular place, and in doing so, you are supporting the network. And for doing so, proportionate to the amount that a crypto you have staked, you are receiving rewards of that crypto. And so this typically goes in as other income, as compared to mining income, which is typically Schedule C style income. It's as if a Schedule C is as if you're running a business. So you would report the fair market value at the time that you are receiving all of your mining rewards, but you also get to deduct out your expenses. You bought mining equipment, you bought space to house your equipment, you bought coolant equipment, you paid an outrageous electricity bill, whatever that is, you get to also take those deductions. So yeah, in general, I guess that's a broad overview, Jared.
Yeah, no, thank you. I think I've heard staking as roughly equivalent to a certified deposit at a bank, where the kind of simple and I agree, this doesn't really work well with the proof of work sort of staking, but it's the same sort of principle, I think, in a lot of ways, that if I go on a platform and I say to that platform, nexo.io is one, or BlockFi, Salt is another. If I go to BlockFi and I stake 5 Bitcoin for 6 months, I say basically I'm going to earn interest off of that staked Bitcoin, and that interest, of course, is other income. I've also heard forks sometimes described as similar to a stock split, where and it's not quite analogous in this situation, but you can kind of imagine, okay, I had one coin and now I have 2 coins. Potentially there's room for growth and additional income there, and seeing how that's handled. I think with airdrops, I know there was a lot of discussion, Max, around both when you have ownership versus when you have control of the coin. And I think part of the issue is that there's some gap of time there where they might issue the coin now when it's worthless, but by the time it shows up in your wallet, it might have gone up to $1. Now, if it's only $1, it's no big deal and not really worth serious consideration. But there have been cases where it's kind of like somebody sneaks into your yard in the middle of the night and puts a gold bar, buries a gold bar in your backyard, and the IRS shows up and says that's income, and you say, I didn't even know that was there. I don't know. Airdrops, I think, have got a little sticky in certain scenarios. Is anything you want to talk about there, or are we good just to kind of leave it at that?
I think it's kind of good to just leave it at the general rule is, I guess, when you have dominion and control over it, it's really just the fair market value at the time you receive it. I guess let's just leave it at that for now.
Yeah, fair enough. I think it's probably enough just to know, hey, this is something you may need to dig into at some point, but no point in really getting much further into it at this point. Any other kinds of crypto income? I think we talked about crypto income. If I'm a business and I'm receiving it in exchange for goods, crypto income from mining, crypto income as wages, and all of this boils down to fair market value. Anything else you wanted to address there?
I'd say those are likely the main ones. I mean, if you're receiving it as wages, it's certainly income. If it's because you're transacting in a business, it's going to be on Schedule C. And forks, airdrops, staking are generally other income.
So I think you brought up a really good point and a real advisory opportunity for people who are mining, in helping them categorize their expenses and saying, hey, look, you can write off everything related to your mining expense on your Schedule C there. I think that's an opportunity to really add some value for your clients there if you're a tax professional.
Right. Schedule C is is meant to calculate what your net profit or loss is. And so I guess one interesting thing here too is that sometimes people will use crypto to buy, for example, mining equipment. So this is an interesting one because the act of using the crypto to buy the mining equipment is most certainly a reportable transaction. Whether or not there's a gain or loss depends on what were the proceeds, what was your cost basis relative to the proceeds. So there's one thing there. But then also that's a expense for your business. So the fair market value at the time of getting rid of that crypto to buy the mining equipment is what's deductible. So there's a lot of moving parts.
Yeah. No, that's interesting. So we ran into this problem back in the early days of crypto, and I think it's still a major issue. And this actually was a topic of great concern as we were talking to the IRS. That people, a lot of times, one of the biggest differences between a crypto exchange versus a bank account is that bank accounts are a lot harder to open. They take forever. Where I can hop onto a crypto exchange and in 3, 4, 5 minutes open an account just because I want to try out their mobile app or something. And so I try it out and I transfer some Bitcoin over to my new Galaxy wallet. And I've taken it out of my Coinbase account. That's the exchange. And I move it into my Galaxy wallet. And then Coinbase at the end of the year says, hey, I have to report. In the past, they have reported to the IRS and said, this person has gross proceeds over $20,000. And it looks like Jared moved $20,000 into his Galaxy wallet. We don't know whether it's his wallet. We don't know where it went. All we know is it left the account. It looks like a sale, and they report it to the IRS. When really, it was me moving it essentially from my left pocket to my right pocket. And so this lack of transparency between accounts makes it difficult to know who's on the other side of the deal. And that's part of the reason why everyone loves crypto so much is there's a fair amount of anonymity in these transactions, or pseudonymity. I don't know, speak to that a little bit, Max. What is taxable and what is not taxable?
Sure. Taking it from the top of the slide, we talked about a few times already. If you take crypto, you buy it with USD, you buy it with fiat, not taxable. As a practical matter, what does that look like? For example, if you use Coinbase, that's probably the most popular exchange in the United States. You can connect your bank account to it. You can click, I want to buy $100 worth of Bitcoin. Boom, click. Not taxable. Don't have to check yes on that form. That's what that looks like as a practical matter. Now, if you, just like you just said, if you take crypto, the $100 of Bitcoin that I just bought, that was not taxable because I bought it with US dollars, and I move it off the exchange into a wallet, that's just as if I moved it from my left pocket to my right pocket. I love that analogy. Not taxable. You can do whatever you want with, you can move your crypto among your wallets anywhere you want. You can sit on your computer all day, loop it around, send it to all your wallets, nothing. Gifting is another interesting one. The act of gifting crypto to someone is not taxable. The important thing to remember for gifting is really a matter of record keeping. It is often good. So if I want to gift Jared 1 Bitcoin, once again, lucky guy. But again, I would want to memorialize in a letter that I'm gifting this Bitcoin to Jared with no expectation of anything in return. It's just a gift. You would also want to include, or I would also want to include the date that I acquired that crypto, my cost basis in that crypto, and I think those are mainly it. You want the things that you would want to report on your tax return are the things you want to memorialize in the letter. What's your cost basis? Right. What's your holding period?
What's your holding period?
And so yeah,
it sounds like that transfers to the new owner as well.
Yes.
And so if I were to sell, if I received a gift and then sold it 1 month later, you'd think, oh, that's short-term capital gain or loss. But it sounds like if the person who gave it to me had held on to it for a year and that was memorialized in a letter, so some sort of trail there, that I can actually claim it as a long-term. Is that true?
Yes. So holding period and cost basis transfer. So if I held my crypto for 364 days and then I gift it to you and then you hold it for a few days, you will be in that long-term holding period.
Excellent.
Tax benefit.
Now, donating to qualified nonprofits, that's been a pretty interesting space, especially recently. And probably not a lot to report on necessarily in this webinar, but just enough to say that that a lot of nonprofits are issuing their own coins now and will offer you coins in exchange for donations. And they're doing this as a way to fundraise. And it's kind of creating some interesting bumping up against the edges of current regulation, because now your donation is becoming a speculative investment. And,
I'm gonna be honest, I'm not as knowledgeable on that, but it kind of sounds like you bought something.
Yeah, exactly. It sounds an awful lot like you did, a lot like you bought something. So 1099s, let's talk about this, because this is interesting stuff. In fact, I'm gonna steal your thunder just a little bit, Max, and go back to the pocket analogy. When I move my crypto from Coinbase to Kraken, and sometimes the exchanges, at least in the past, the exchanges have reported, and none of that holding information, none of that cost basis information transfers between exchanges the way that it would if I were to transfer, say, Facebook stock from say my Chuck Schwab account over to my TD Ameritrade account. They would automatically transfer that information. There'd be a paper trail. That doesn't happen in crypto, and so we end up with all these gaps in information. And I think it kind of falls down on this 1099, and everybody says, well, wait a minute, there's 1099s. Don't exchanges file 1099s? So what's the answer to that? Do I get a 1099 at the end of the year from Coinbase?
Right. So you'll get a 1099, I think it's like a 1099K from Coinbase, and you really can't do anything with that. You hit it on the head perfectly earlier, is that stock exchanges, so not crypto, we're in stock world, they issue 1099Bs, which is sort of just the holy grail of tax reporting there, because it has the proceeds, the cost basis, the gain or the loss. You just take the form, upload it to whatever, give it to your accountant, whatever you're going to do, and you're done. You don't have to think about it. And it's especially true that if, let's say, you move your stock from one exchange to another, they will communicate the necessary information, the date acquired, the cost basis, and you have nothing to worry about because they talk to each other. But whatever, Coinbase and Kraken don't communicate information to each other. They don't communicate information to whatever, foreign exchange, an exchange in China. They don't communicate that information. But you, as the taxpayer, are free to move your crypto wherever you want. And so there isn't a form that exists that will aggregate all of that information for you. And so you need a software that will aggregate all that information for you. The other thing, I guess, to touch on a general level here is how do you do that? Like, if I bought some Bitcoin on Coinbase and I bought some Bitcoin on Kraken, I bought some Bitcoin on Binance, and I moved it all around, how do I know what my cost basis is for everything? The answer is generally you have to use FIFO, first in, first out, which a lot of people hate because it oftentimes results in people having gains when they don't realize it. But that's really due in part to the fact that FIFO is really the only way to go, because you don't actually know the cost basis of that crypto. Now, some people get frustrated because they wanted, in their head, they're doing what's called specific identification. FIFO is the default, but if you can identify specifically what the cost basis and holding period is, then you can get away from FIFO and input those numbers yourself. But most people aren't able to do that because they have so many transactions.
Yeah, it becomes tough to aggregate all the data. You spend so much time aggregating the data, and then you have to turn around and analyze it. And we've seen people do this on just in Excel, And for just a simple exchange, a simple filing, you're looking at sometimes 2,000 transactions,
Right.
and crunching all of that in Excel is a nightmare, especially because they're coming in different CSV formats. Some exchanges will give it to you in a CSV. Some will give it to you in a spreadsheet. Some will only give you 30 days at a time, and so you end up having to request 12 separate files. I mean, it really gets hairy fast, getting the transaction data from the exchanges, I think.
Right.
So, and I think that leads really well into the problem for accountants. Um, the 1099-B that you would get from a brokerage, from a stock brokerage, really precludes any need for the form 8949. You've got one form from a recognized brokerage that's compliant in the U.S. and you use that instead. For all the crypto transactions, you end up having to list every transaction on form 8949. And you can imagine going to your clients and saying, wait a minute, you used Bitcoin to purchase a cup of coffee every 2 or 3 days all year long. and the tax accounting nightmare that creates. And of course, the client doesn't think about that. They're not thinking, oh, my accountant's going to hate me for this, when they buy their cup of coffee. But then you need to also go out to every exchange and every wallet and get disparate information, sometimes in foreign languages, and bring all that data together as well. The trouble you run into as a tax firm is that you end up trying to bill your client hourly, and a typical return that way ends up running about 40 hours. And if you're billing out $200 an hour or even $150 an hour, you're slapping your client with a $6,000 tax bill when it's probable they aren't even holding $6,000 in crypto. And so for that reason, a lot of medium-sized tax firms have just flat out said, and smaller sized tax firms have just flat out said, we just won't do it. You're going to have to go to a specialist and get it done. And that's kind of where ZenLedger comes in, and where Gordon Law Group comes in, where we can kind of help you with that lift, help you. So your people don't necessarily have to become experts, and you can engage on whatever level you're comfortable. If you want to do it all yourself, great. You can use ZenLedger as a tool as needed. If you want to go to the other end of the spectrum and say, hey, we just want to hand this off to outside counsel and use pass-through billing, I think that's where Gordon Law Group comes in and fits really well. The alternative is a lot of tax firms try to do this in-house, and they end up either losing money or they don't offer it, which becomes a problem as compliance increases and as enforcement increases. And then, of course, the other issue with doing it on your own or doing it without the help of a sophisticated software like ZenLedger is that it is so onerous. There's so much data that it's extremely difficult to do it without errors, and it's also extremely difficult to check somebody else's work. And so having the help of some powerful software makes all the difference in the world. So ZenLedger pulls in the information from the wallets and exchanges. We have API connections for a lot of the wallets and exchanges. We'll do the full accounting, and after we've aggregated all the data, sanitized it, standardized it, we then output a full audit trail, so you can see every transaction in every one of their exchanges and wallets. We also populate all the U.S. tax forms related to crypto, including some of the more obscure ones, like if you lost a wallet or had your crypto stolen, then it'll automatically populate those tax forms as well. Which is one of the reasons that groups like Gordon Law Group ends up using ZenLedger, because we offer powerful software that's next to none, along with powerful back office support, and that can mean that we support you, or it can mean that we support the Gordon Law Group as they take care of your clients, or it can mean that you kind of hand them off, and whatever level of engagement you're looking for, we're happy to accommodate. Max, I think we're on to your slide here.
Yeah, I mean, you pretty much said it all. If you want to outsource doing the crypto portion of a tax return to us, we do that all the time. Oftentimes we have clients come to us, they say, hey, my accountant maybe knows a little bit about crypto or doesn't know anything at all. Can you just do the crypto for us and then communicate that to my accountant, or communicate it to me in a way that I can just present it to my accountant? And the answer is yes, we do that all the time.
I think you guys until his recent demise, you guys were representing John McAfee, weren't you?
We were, yeah, but that was completely different. We were representing him in his crimes related to cryptocurrency. So
I think it says a lot that these high-profile cases. I'm completely unrelated. A guy that I followed on Twitter that
alleged crimes, by the way, just alleged.
Alleged, right? Thanks for clarifying. Although I don't think that his case will be proceeding at this point. So let's run through. I think we've got about 5 minutes left here. Let's run through a few of the questions that you guys have been posing throughout.
Good questions in the document here.
But yeah, sorry, go ahead.
No, I was just going to read some off the top of the document here, unless you want.
Yeah, there's a few related to fair market value. One from Janice and one from Elizabeth saying, what do you do in the event of an audit to prove your fair market value calculation? How do you get a spot price? If I were a tax pro trying to find a spot price on crypto, what are your recommendations there, Max?
Really, the softwares are always going to populate the spot price for you. I believe they usually use some sort of daily average price, grabbing it from multiple sources. In my experience too, if I can't find a price, I might research it on CoinMarketCap or CoinGecko, or do my best that way. But usually the software is aggregating it from multiple sources. So typically the technology, we don't have some magic book that says what's the fair market value. It's always going to be through technology.
And in my experience with the IRS, it kind of comes back to defensibility and consistency. That if you say, hey, this is our established procedure, our firm has an established procedure for establishing fair market value, this is what it is, and we've applied it evenly across all of our clients. I think that kind of passes the sniff test. Would you agree with that, Max?
I would. Actually, I'm reading this document too, not to jump to a different question.
No, go right ahead.
Bradley asked a really good question. Bradley asked, if you're in a loss position, why would you be required to report it? For example, if you buy Bitcoin at 55,000 and dispose all of it or a portion of it at 45,000, wouldn't reporting that loss be the prerogative of the taxpayer? Aren't merely gains required to be reported? There's a few answers here. One, the answer is no, gains are not required to be reported. Dispositions of capital assets are required to be reported. You have to report every trade on Form 8949, whether or not there's a gain or a loss. And the part two of this is that you have every incentive to report your losses, because your capital losses will offset other capital gains and your ordinary income up to $3,000. And unused capital losses can be carried forward to the next year. So do you have to report losses? Yes, you have a duty to report everything. Should you? Yeah, absolutely. Because you lost money, and by reporting it, you get to deduct that from other capital gains or ordinary income. So you have to, and you should, and you have every reason to.
Thanks. Hey, Max, here's a question maybe I should have added my own question to the document. When we've got clients who are trading in foreign accounts that specifically prohibit Americans from trading on their platform, like Binance. Binance has a US version, and then they have the global version. And the global version does not allow US citizens to trade. But there are workarounds. And when our client comes to us and says, hey, I'm using an unauthorized exchange, How do you handle that as a as a tax professional? Do you report it anyway, or do you say, go burn that and let's pretend like we never had this conversation? How do you handle that?
Report it. The IRS cares first and foremost about reporting. They most certainly would just want you to report those trades. And so we always, from foreign exchanges, likely that clients or U.S. citizens are probably not supposed to use. We report every trade because that's what the duty is, and that's what you're supposed to do. So it would be much better to report than to only report your American exchanges. In fact, we've represented people in crypto audits who only reported American exchanges and are being audited for underreporting income because they incurred capital gains other places. And yeah.
And I think that's one of the things that I think isn't necessarily widely understood, that if you are an American citizen or an American permanent resident, that you have to report your worldwide income, not just your US income. And I think that topic has been kind of brought to the fore by cryptocurrency, because it's so easy to be paid in cryptocurrency into foreign accounts or into accounts that never touch American soil. But as an American citizen or permanent resident, a green card holder, you're required to report your worldwide income. At least that's my understanding. We have number 22 here. Anonymous asks, as a tax firm, do you accept crypto as payment from your clients, and what are the rules there? But Max, I know you guys do accept crypto, so
Sure do.
You're probably in the best position to elucidate that.
Yeah, we accept payment in crypto. I mean, short answer, yes. I'm not really sure how else to answer this.
Yeah. So are there any specific considerations, things like AML or KYC, that apply to crypto that wouldn't apply to a US dollar payment?
Like on our part, like if you're paying us, I mean, typically how getting paid in crypto works, like a lot of companies use a program that's called BitPay, and you receive payment through BitPay, and the merchants can decide which crypto they will accept payment in. So we don't just get, a million, ABC coin that someone just made on their computer. Like we accept Bitcoin, Ethereum, USDC, Doge, so usually the merchants are able to say, like, I will accept payment in specific types. So, yeah.
So you can limit it and say, hey, I only accept Ethereum and Bitcoin, or Ethereum, Bitcoin, and Litecoin, or something.
Yeah, 100%.
And then you would report your income just on fair market value in US dollars at the time you received it. Is that right?
Yes, and likewise, the payor in that situation is using crypto to purchase goods or services, and therefore has a gain or a loss relative to their cost basis.
And I'd imagine they could use the fair market value of the crypto at the time, or maybe even your invoice as a supporting document for the fair market value of the transaction, I'm guessing.
Right.
Well, I think that's it. We're at the top of the hour, and Max, thank you so much for your time. I know there's a lot of questions we didn't get to, and Hannah and Max and Spring and I will work our brains out to make sure that we get all those questions answered by email. Of course, you're always welcome to contact us and ask questions directly. That's why we do this, right? We're trying to generate revenue. We're trying to generate clients, and the way we do that is by saying, hey, we are here to help. So by all means, reach out, and we're happy to help. Part 3 will be July 29th. You can RSVP. We'll send a copy of these slides and a recording of this webinar to all the participants. And so that link will work for you there. And there you have it. There's our contact info. And by all means, feel free to reach out if there's anything we can do. Personally, I'm interested in asking Max where he got that shark on his wall. I think it's fitting that an attorney has a shark on his wall for art. So maybe you'll keep an eye out for an email on that, Max.
Oh yeah, for sure. And yeah, my email is on the screen. You can email me, maxm@gordonlawltd.com. And if you have questions too that we didn't answer here, you can email spring@zenledger.io, spring like the season at zenledger.io. So yeah,
Awesome.
feel free to reach out.
Hey, thank you so much, everybody. We sure appreciate your time, and hope you feel it's been worthwhile. We'll hopefully see you again soon. What is it, July 9th, right? Yeah, 29th.
Yeah.
Sorry, July 29th. I guess July 9th already happened, didn't it?
Yeah.
So until then, thanks, guys.
All right, thank you.